Let's start with base case views from our last cyclical forum, where we summarized our economic outlook as peak pandemic, peak policy, and peak growth. Can you please provide an update on where we are relative to those views today?
The three Ps, I think for the most part, that view has played out and then has priced in the market accordingly. So the question is, from this point on, where are the opportunities? So for us, the focus are on three dimensions. One is the Delta virus, whether it's peaking and inflexing. And second, whether the Fed is going to taper or not taper. And thirdly, clearly China has been tightening and slowing down this year. And from here, whether the PBOC is going to start to ease and China's economy going to recover.
So in the traditional macro playbook, if we agree we're in the mid-cycle stage, the focus would be more on directional positions to harvest those risk premiums. However, while the real economy may still be in that expansion, financial assets in many cases seem to reflect pricing more typical of late cycle. So can you talk about how one positions broad and flexible portfolios in such a regime?
I think there is, at least based on historical experience, there is a major disconnect in the market in terms of the mid-cycle expansion, but late-cycle asset prices. Although I caveat that, we don't know whether it's just a new normal because there's so much central bank liquidity. So the asset prices are potentially going to stay at these relatively rich levels by historical standard. So I think if there is a big economic shock, some elements of the traditional macro still apply. One can take advantage of the market dislocations to take concentrated directional positions. But for the most part, in the low volatility mid-cycle market, I think one really has to think about the portfolio construction a lot more thoughtfully in terms of constructing a portfolio that can perform under a variety of scenarios and really use the global resources and then do both directional and relative value strategies in single asset and across assets. And then thinking about long convexity positions balanced by risk premium harvesting strategies.
So can I ask you to describe areas of your current focus and opportunity? Where are you and the team spending the most time right now?
We always look at a lot of things. We look at the global markets, and as you know, we have a big team. But for now, most of the focus is developed market interest rates. And the volatility in the market is pretty low. So we want to use the market opportunity to construct positive convexity positions that give us exposure to higher interest rates in the market. Last year, we took advantage of the market dislocation to get long mortgages against different type of interest rate hedges. And then this March and April, we flattened out the position as mortgages reach to historical rich levels. And if the Fed is going to taper, we think the mortgages are going to start to widen from historical rich levels. And thirdly, in corporate credits, in partnership with our global credit team, selectively we are adding exposure in potentially COVID recovery sectors, and also some corporate credit names that we think can benefit from secular disruption and some sustainability ESG initiative. And in mid-cycle, when volatility is low, one should focus on systematic strategies as well, try to harvest some short-term market dislocation and the risk premium. And that is in partnership with our analytics and quantitative team.